Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap. And we've got stocks down as investors are unable to shake off the recent pressure with the threat of new tariffs from President Donald Trump. The S&P 500 dropped 1.4% to close at 5,522 and ended the day in correction territory, 10.1% off its record close. The Dow Jones Industrial Average was down 1.3%, making it 4 straight days of losses. And the Nasdaq Composite lost 2%. For more insights, we are joined by Brenda Vingiello. She is the Chief Investment Officer at Sandhill Global Advisors. Brenda, good morning. How are you doing today?
Good morning. I'm doing well, but every day is a new day these days.
It is.
So not great to see the market do what it did today, but it's unfortunate, but it is what it is.
New day, new tariffs, and the latest on the table revolves around alcoholic products coming from places like the European Union. So President Donald Trump has threatened 200% tariffs on them in retaliation for their 50% tariff on whiskey. Walk us through what has been the latest market reaction and what's been the impact on the markets with all these tariffs going back and forth.
Sure. Well, I think we're in this period of incredible uncertainty. I think we started out when the tariff talk really picked up. A lot of investors felt this is just posturing. Nothing's actually going to be implemented. This is all part of a strategy of negotiation. But as time has gone on and we have tariffs now that are being imposed, people are still of that view, I believe, and we are as well. When you look at what the real impact would be if tariffs, even the ones that have already been imposed, stay in place. But the time, in my view, it just depends on how long we're in this state of confusion. Does it last a couple of weeks? Does it last months? And I think the longer it lasts, the more there is for potential economic harm and harm to corporate earnings. So I think that is what the market is really focusing on, is this uncertainty. We've certainly heard from a lot of companies that have supply chains coming through Mexico and Canada and, of course, China, and already kind of ringing the alarm bell about what this will mean for their customers. We heard it from a lot of retailers, like Target, for example, recently in the U.S. that, the cost of groceries, a lot of produce comes from Mexico during the winter months. So that's something that's going to have a direct impact on the consumer. So that is really where the focus has gone. And I think there is a chance to clear this up within a few weeks' time, but whether that happens or not, we don't know.
Yeah, Brenda,
I think the longer the uncertainty lasts, the worse it could become.
Yeah, I'm quite curious, how much was a surprise? Because we knew Donald Trump was going to come up with tariffs, and we saw a bit of a bounce when he came into the office, and that's where we saw Trump trades really taking off. But now, in the space of some 8 weeks, it has turned around. In fact, many of these Trump trades have gone underwater before he even took office. So we are seeing a bit of a reversal here.
Yeah, I think immediately after the election, there was a lot of hope about this current administration being more business friendly. And the 4 things they're really targeting, right, or they've talked about targeting, is trade, immigration, fiscal policy, and regulation. So if we think about those collectively, the thought was, well, some may be harmful to the economy, others will be helpful, but in general, it should be a more business-friendly environment. And so far, we've really tackled the trade piece first here. But I also think if we look at the tariffs that are even currently imposed now on Mexico and Canada, if they stay in place, which we don't think they will, but if they stay in place as they are today, they are going to be really damaging to the economies of Canada and Mexico, and also ultimately harm consumers with prices moving higher. We don't think that's the ultimate goal here. So our view is that over time, these, things will get worked out, and there may be some tariffs that stay in place, but not across the board tariff on all goods coming into the country from those 2 places. So I still think we're in this area of uncertainty. I don't think anybody thinks that the goal of this administration is really to crater the economy into a recession. But if we look at what's happening so far, there's been so many imports coming into the U.S. the trade balance is having a negative impact to GDP. And that is because everyone's trying to import ahead of tariffs potentially being imposed. So there is a chance that we could have a negative GDP quarter in the first quarter here. We'll have to see how things shake out in March. But that's also not going to be good for overall sentiment. So it just, in my opinion, means that we need more clarity about whether there are going to be lasting tariffs or not. And unfortunately, the tariff talk from the White House just changes daily and even intraday many times. So it's a lot to keep track of, and it's causing a lot of confusion. And so that is ultimately, I do not think it's not good for companies that have supply chains with goods coming in from other places. It just creates a lot of uncertainty and unknown about how they are supposed to be planning their business. And, investors are trying to make sense of that and understand how it's going to impact earnings and looking forward and saying, well, it might actually have a negative impact, which certainly would not be good.
That's right, Brenda. So that R word is back. In fact, some folks are even calling it the Trump session. Goldman Sachs has raised the odds of a recession from 15 to 20%. JP Morgan is calling it at 40%. So there is quite a lot of uncertainty in the air right now. What is the playbook here for investors? Where should they be positioned right now? Should they be cutting exposure or should they be picking up anything on the bargain?
Sure. Well, I think if we look at technology stocks, those are the ones that have really experienced the biggest correction. I think there are some opportunities being created there now because valuation has become more attractive. But I also think that this year is a good lesson in how important it is to be diversified. So if we look at other asset classes, for example, European equities have done quite well this year. Bonds are doing well. Commodities are doing well. REITs are doing well in the U.S. So there are a number of asset classes that are actually acting as a great buffer to what's been going on in the broader U.S. Equity market. So I think being diversified is really important, but I think we are getting to a point now where it's looking like it would be interesting to add a little more exposure to some parts of the U.S. market, but knowing that we still don't have clarity about when this is all going to be settled and when we're going to have more clarity on what the actual tariffs are going to look like. So that could cause more volatility and certainly could be a little bit more downside from here, but it feels like we're getting close.
All right, Brenda, talk about clarity. How clear is it for the FOMC when it comes to rate path forward? Are we looking at, I suppose, odds of more cuts?
Yeah, so we just heard from Jay Powell last Friday, so about a week ago, and he really had some calming words for the market in that moment, but really was a look at how the economy in the U.S. is still quite healthy. That it conveyed that policy was appropriate today, but certainly if economic trends were to weaken, that they have a lot of room to lower interest rates. So that's the good news in all of this, I think, is that as long as inflation remains contained and if the economy does start to weaken, the Federal Reserve certainly has the ability to lower interest rates. And that's quite different from the environment we were in 4 or 5 years ago when interest rates were so low that there really weren't very many levers that the Federal Reserve could pull to try to stimulate the economy.
All right, so we'll be watching out for that very closely next week when the FOMC meets. We've been in conversation with Brenda Vingiello. She is the Chief Investment Officer at Sand Hill Global Advisors. Brenda, always a pleasure chatting with you. Thanks so much for your time and insights.
Thank you so much for having me.
All right, we'll catch up with you again soon, Brenda. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.